Welcome back to the channel. So this is your ultimate guide to chart patterns. So there are a lot of different chart patterns. I'm not going to cover all of them. I'm going to go through the main ones that people should realistically know. Some short term, some long term, some continuation, some reversal, bearish and bullish patterns. You shouldn't really rely on chart patterns as a whole, as they do affect some of the market, but also you got to bear in mind there are other factors that also affect the market. So the chart patterns are also useful to know, and everybody should know them if you are trading, whether you're spot trading for long term or whether you're futures trading short term or long term. So they are good to know. So we'll start off with the easy pattern. This is quite a common pattern that a lot of people will use. It's called the bearish head and shoulders pattern. So the bearish head and shoulders pattern, you might have some trading upwards, and then you might have some a little more trading, but where you set a little bit of a high, come back down, and then you set up another high which is about equal to the previous high. So it looks something like this. So you'll set a high over here, you set a slightly higher high over here, and then you set a similar high to the previous one. So this would be your right shoulder, this would be your left shoulder, and that will be your high. So the way this pattern would work is you would set this pattern, you might have a bit of trading up to here, trading back down, trade back up, trade back down, trade back up, trade back down. So this would be a head and shoulders pattern. The way you want to make sure this actually validates and confirms is you'd have a neckline. So once it breaks this neckline, well, that's a horrible drawing. There you go. Yeah, right. So you have a neckline. Once you break this neckline, so once you come under, you'd have to come back up and retest again. Once you retest, then you can make a measured move. So your measured move will be from the top of the head, up here, all the way down to the bottom. And that'd be a measured move, so we're drawing a different colour here. That'd be a measured move. And then you could take this line and you can move it down. Normally you would do this in TradingView. Obviously I'm doing Samsung notes for the sake of this. I will do some price analysis videos at some point where I do some measured moves and stuff like that for you. So I have this move and you move it back down all the way over here. Normally for an entry on this chart, what you would usually do is you'd enter after, obviously most people might enter, up here on the left shoulder. It's not really a good idea because you can't 100% say that the chart has actually, confirmed the pattern. So I know a lot of people will enter over here, but this isn't really a good place to be entering. You want to wait till you actually have a confirmation so you don't lose any of your capital either. And obviously bear in mind these chart patterns can also be confirmed and then also be invalidated after as well. So you normally will have a pattern that comes down over here, it'll come back up, and normally you enter over here on the retest. So you'd enter over here on the retest, and then you'd set your stop loss slightly above where the pattern started. So over here. So you enter, your stop loss will be over here, your entry's over here. And then after you've entered, if you want to take profits, normally what I would say is you don't really go for the entire length of this, because sometimes it will not go the entire length, sometimes it'll even go even further. So normally a good thing is to go maybe about 75% of the way down the measuring move, put your take profit here. So you put your take profit here, entry over here. Sorry about the handwriting's not great. And then you go put your stop loss over here, slightly above where you've entered. So that way, if it does reverse and it does come back up here, you don't really lose too much money, and you try to prevent as many losses as possible. Right, I have got some examples of this. I haven't got examples for all of them, but I have got some examples. So this is a head and shoulders pattern that was on the Bitcoin chart quite a while ago. This is on the daily time frame. This is from quite a while ago. So we had a bit of a trend up, set a high over here, came back down. That's a shoulder. We had another shoulder over here where we traded up, came back down. And then we had our head where we traded all the way up to 69,000 and then came all the way back down. And then we also have our neckline. It depends how you choose to draw this pattern. It's a bit of a harder pattern to understand because obviously, realistically, you want to be on a logarithmic chart to actually see it properly. This high over here may look like it invalidated, but it didn't. It's not actually that much higher than the previous pattern. So if you were to draw it something like this as your neckline, that'd be decent. So you have like your shoulder here, you have a shoulder here, and then you have your head over here. And then obviously once we broke, so we broke over here, came back up, traded around, tested, and then after that we came down. So I've actually got this one drawn on TradingView as well. So this is our actual head and shoulders, this is how I drew it. We came up, came down, came up again, came down again, it came up again, and it came back down again. And then also we come down. You can say you tested over here, or you could say we tested over here. It depends how you say it. Realistically though, on the shorter time frame, if you zoom in, you can see we did retest there. But I don't really think that's a neckline. This is a bit drawn badly, but realistically that was realistically a neckline. So it looks like we retested over here. And then obviously our measured move brings us down, and you can see this one actually did play out quite well. And it came all the way down to, give or take, roughly about our price level. This line was measured, this line here, was measured from the head, just like we do on a normal head and shoulders. Right, so we'll go to the next pattern. So this is a bearish flag pattern. Right, bearish flag patterns can come in a lot of different forms. They don't always have to be the same, because you can get obviously different words for them. Like, a lot of people call stuff like patterns, you know, like the pattern, you got the pennants, you got the normal flag where it trades sideways, but I'll show you most of them that you can actually get. So the most basic form of flag pattern is where we trade down, might not be a straight line, but for the sake of this it is. We trade sideways a bit. That's a horrible drawing. We trade sideways, give or take. And then we have our resistance up here, and we have our support down here. And that would be a basic flag pattern, and then you'd measure, as you would normally, you'd measure the flagpole, and then you can draw the flagpole downwards. And that'd be your breakout, and then you can put your stop loss after you'll see retest. As you would do all these patterns you would have to retest, so I'm not going to mention that in all the patterns, but normally you do have to retest first, and then you'd come back down. So on this pattern, when we do take the retest, so down here, we retest and we'd come down. You'd realistically go to enter on the retest, so your entry over here, entry, whoa, I've got a lot of cool owls, right, entry, and then obviously up here, you put your stop loss back in the range. Because sometimes you can have fake outs where you do come out of the trading pattern and then you just go back into it. And that could be, you know, sometimes market manipulation where we go upwards instead. It depends what time frame you're on. Realistically, chart patterns that are on a longer time frame are a lot better than on short time frames. Because on longer time frames are more likely to be accurate. And also, you should realistically expect at the top of the ranges, so up here, where we touch our supports and resistances, you should realistically expect a high amount of volatility. And if you expect a high amount of volatility up here, that'd be, you know, a high chance that we will, obviously, you know, the pattern will break properly. Also, you want high amounts of volume on all the points. You can also have separate types of patterns as well for flags. They're all roughly the same sort of concept. You might trade downwards like this, and then you might trade maybe, let's say you trade side to side up here like this between your supports and resistances. So now what you're doing is you're saying lower, right, okay, I'm saying it wrong now. You're saying higher highs up here, then you're saying higher lows up here. So that'd be similar to what a rising wedge is. And also you got flagpole as well. And then also the same thing as normal, you'd measure this move and you can measure it downwards. Like that. You can also have other patterns too. So there's something called a symmetrical triangle. So let's say we trade straight down. It's very unlikely to trade straight down. But yeah, let's say we trade straight down. So a symmetrical triangle would normally just be a normal triangle. Normally on short time frames you don't really see many symmetrical triangles. They're more on longer term time frames. So if you do see something where it is a flagpole, so just straight line trading down, and then afterwards we put in, you know, some side to side trading with lower lows, with lower highs, and then higher lows. You can have some trading in between the range like that, and then we come down from there. And you measure your flagpole again, and you'd come down. And that'd be your flag for something like that. And then obviously I've got an example here. This is obviously, so we put our flagpole over here. That's our flagpole. And then, just redraw that one. So it doesn't edit it again. Right, I guess we're doing it free-handed. Right. That's our flagpole. Give or take. You can include the wicks if you want to. You don't have to include the wicks. I like to include the wicks depending on certain patterns, but you don't have to include it. You can, if you really, really want, just include like the main part of it. You don't have to include the wick. It depends from people to people. I normally try to draw whatever looks the best to me. I don't draw all of it. So it does depend on how you want to do it. So we basically had a bit of a trading around here. That is our support. We had some trading up here. That's our resistance. Then also we take our measured move like we would normally. So let's say this is our measured move, and we trade all the way down. This pattern did play out quite well. And that is our flag. This is, if I remember correctly, this was the 2020 COVID crash that happened. So we did have some trading. We had put flag in, a bearish flag, and then we came down. The next pattern is a bearish double top or triple top. Right, so these can come in many forms as well, like a lot of the patterns. You can't be accurate with what pattern looks like, because a lot of patterns can look different. They're not always going to be the same, and it can depend. So the most common double top is something like this. You'd come up, set a high, come up, set the similar high again. Now, you set a price up here, let's say this is, I don't know, 66,800. We'll say this is Bitcoin, and then this is 66,000, I don't know, 810. That's a very similar high. It depends what time frame you're on. That'd be basically a double top. So we've basically come up, come down, and that's it. Now, if you wanted to measure this pattern for a move downwards, you'd measure from here to here. Let's say that's your move. Our neckline for this pattern, let's say you drew it like this. Once we break this, we come under and we come back up for a retest. Like this. So you come down, might break down here, and then we come back up for a retest. And then obviously realistically the same as always, you'd enter roughly at the retest, put stop loss slightly above, over here maybe, and then you can take the measured move, so our orange line that we drew here, you take your measured move and you can move that down. Realistically, so you want to do some trading view so you can actually move the lines before, you know, educational purposes, I guess. I'm doing it on here, but you can do it on trading view obviously to actually move the lines out properly. So you come down, and then you maybe put your trade profit, I don't know, at like 75% maybe. Obviously with this same pattern, the same as every other pattern, if the pattern's invalidated, so let's say we come down for the neckline, we come down, let's say instead of coming all the way up, retesting and coming down, let's say we come down, come up, and then we go up even higher, that's not invalidate the pattern, and that's why you should always put your stop losses. Because you don't know when that can happen, because it's very common to happen. These patterns aren't 100%, you can't 100% rely on these patterns either. So you gotta be wary of that too. Now, another double top you've got is something like this. You might come down and come up and trade up to the same price. So you might trade down, come up, trade up to the same price. Let's say that's a top, that's a top. Now, there are different patterns like this. You can have something called a cup and tea handle as well. Now, a cup and tea handle, I'll show you in later on in this video. However, you can have a pattern where you basically just come down, trade up, and you take a similar measured move, measure from here, and then once you come down, you can put the line down to measure your move. Same as always. There is again also a double top as well. There are multiple different things you can have. A triple top is something like this. So you come up, get up to a price, come up again, come up to the same price, come down again, come back up to the same price. It looks similar to a head and shoulders pattern, although the prices up here, so these areas will always be roughly the same. Whereas with the head and shoulders, this price in the middle will be slightly higher than the other two. So you want roughly the same price at all these points. And then same as before, you take your measured move from here, and then you'd basically trade down, come down, and then you trade lower. Your measured move will obviously be from here to here. Not all these patterns have measured moves, so be wary of that. It's not all of them you can measure, but that's roughly how you would do that one. So that is a triple top, and then some double tops. They can come in all different types, and obviously if you set a similar kind of price, that is an indication that you will go lower as well. So you got to be very wary of that. I did bring an example for this one as well. If I remember correctly, I think this is the COVID crash. I don't think it's the other one. I think this is the COVID crash in Bitcoin. So as you can see up here, we set a high. And then up here, we also set a high. These highs are very, very similar prices. And then obviously what we've done is, let's see, we've had our crash here. Let's say we take our measured move from here to, I don't know, here. It depends on whether you want to include the wicks or not. Like, if it was me, I probably wouldn't, like, draw it all the way down. I'd probably draw it from, like, about here to here. It depends on how you want to draw it. But that's why I say it depends on your drawing. That's why you shouldn't take profit at, like, you know, 100% of the length of where you're going. So you want to basically take it, like, I don't know, 75% of the way down. Maybe, like, this is the line here, this blue line. Maybe you take it, like, 75% of the way down. And that way you can be a lot safer. Because you don't know if it's just going to randomly reverse. Because when these patterns do come down, they do reverse quite fast as well. Because they can come down, it might come straight down, and then you might reverse quickly, so you might just come back up really quickly as well. And then obviously this pattern did play out. We took a measure move from here, and then obviously once we broke, we did come down. So it does depend how you draw it. Maybe this one moved a bit more. So after the pattern does play out, sometimes it can move, you know, it can continue moving down, or it can continue going back up. It depends on those, you know, circumstances and how the market is doing at that time, how much volatility, how much liquidity is in the market. So that's obviously your double top. That's one example of it. I have not a clue what's going on here. One sec. Right, let's move that up. I originally drew these patterns before, obviously, so we could test what they actually look like on here. And I had to colour it over with white, because apparently for some reason, right, once you come off this, you can't get rid of these lines here that I've drawn. So I can't get rid of these unless I basically go back on there like that, and then that would get rid of it. Other than that, I can't get rid of it. So you got your bearish rising wedge. Some of you have already seen the example at the bottom there. Your bearish rising wedge is something like, let's say, you trade upwards. So let's say we have our resistance up here, and we have our support up here. So you'd have something where you trade in between this range, touching the tops. Same as you would normally between most patterns. You trade around. It won't always be just a zigzag, by the way. Sometimes you can have like weirder trading. Like sometimes you might just trade upwards like this, and then you might just stop midway and then just trade like sideways, and like you can have a very weird trading a lot of the time. It doesn't have to be exactly a zigzag. This is just for, you know, drawing purposes. So the difference between this and a flag, right? So you can have a flag where the flag is basically, let's say you trade downwards into this range, and that way you could take a measured move downwards. However, without that, obviously this is just an indication that we're going to go lower. You can measure these to some extent. Some people would say you can measure it from here to here, and that's your move downwards. Others would say that this is just a this is just a reversal pattern. So if this is, let's say we trade, I don't know, we trade upwards into this. So we trade upwards like this. We trade upwards into the pattern, and then we come back out the pattern. So this would be a reversal pattern. So we basically, our trend was going up, and then we come down now. That's our reversal. You could also trade down into it and then trade out of it, but that at that point in time it would now be a flag. Do you see the difference? So you can have two different types of trading into it and out of it. And that's how it can be a continuation or a reversal pattern. That would be a bearish. And obviously the same thing as most patterns. So the last one, I'll explain this one on. You come out of the range, you come back up for a retest, and then you trade down. This is obviously the rising wedge. This is the bearish one. No, there can only be a bearish one anyway for a rising wedge. Rising wedges tend to be bearish. Obviously, bear in mind, right? So let's say we did trade. We could actually end up trading back up and then going higher instead. So these patterns aren't always accurate. So you do need to be very careful with your stop losses and where you trade. So let's say you don't enter until you come out. You come out and then you enter right up here. And make sure you put your stop losses. Because if you don't put your stop losses, you will get wrecked. Because sometimes the patterns can come back up. Here is an example of a rising wedge. This is again the COVID crash. The COVID crash actually presents so many patterns. It's actually such a good one to analyze. So yeah, that's why I've been going for this one. So as you can see, we've had some side-to-side trading up here, saying obviously higher lows over here, higher lows, and then setting higher highs as well. And that's what a rising wedge is. Saying higher highs and lower lows, and that's what a rising wedge would be. Obviously, that is what it is. And then also we've broken. This is on the daily time frame, so we might have retested on the 4 hour maybe. But we'll see broken. If you draw this line upwards like this, we've broken, come down, and come up, and then that's our retest, and then we've come down. So yeah, that is obviously our pattern that we've got here. Next, we've got a narrowing symmetrical triangle. So there are two types of symmetrical triangles you can have. One of them is actually quite rare, like you don't really see the other one, but this is more of the common one. So your symmetrical triangle, you draw something like this. You might have some trading like this in between this range. Let's say we have, I don't know, some side-to-side trading like this. Something like that, where it gets narrower and narrower. And let's see, we've set lower highs over here. As you can see, we set some lower highs, lower highs, lower high, lower high, lower high. And then we put higher lows in as well. Now, this pattern, obviously, if it's followed by a flag, let's say it's followed by a flag coming, I don't know, like down, that's our flag, let's say, and once we come into this range, we trade down into this range like this. This is our symmetrical triangle, obviously, so we can also take a measure and move over the flag, like let's say that's our flag, we can measure it downwards. So that'd be a flag. Now, if you have the symmetrical triangle on its own, let's say we've just had like a long-term trading, like these sorts of patterns, like the symmetrical triangle would most likely show up on like higher time frames. They're quite rare on short time frames, and if they are on short time frames, they are normally followed by a flagpole, or they do come, you know, before a flagpole, or after a flagpole. So they do come after the flagpole. So you would realistically have like some trading where you come down and like have your triangle, trade around in it, then you come down. So you gotta be wary of that as well. So it could end up being a flag. Now, this pattern's quite interesting. This can actually break both ways. So it depends on which way it will break. So you can have a break downwards, and you can also have a break upwards, depending on which way it enters. So sometimes on these patterns, well, most times you will actually have a fake out sometimes. So you could have something like where we trade out of the range for like a brief period, we come out, and then we just come back into the range again. And something like that is quite common as well. So you gotta be wary of that as well. Make sure you set your stop losses quite tight. So normally, if you, let's say, we come out of here, trade out of here, come up for the retest up here, you can put your entry here. Maybe put stop loss slightly inside the range, and then obviously you could take a measured move for this one, like you could with most patterns. It depends on how you want to take it. You can measure it from here, maybe. If you want to go for the extreme, you can measure it a bit further down here. Let's say that's our measured move, and we move that down, and that's our measured move downwards. Obviously, the contrary, you can also have a move upwards as well. If it breaks the other way, and the same thing, put your stop loss and put your entry, and obviously, you know, take profit as well. And then obviously we have an example for this one. Right, so this one hasn't played out. This is just an example of one I could see. It's quite hard to find these, to be honest. So this is our triangle like this. This one's not fully done yet. And then also we had some trading that we were going down into here. Now, the interesting thing about this is sometimes inside these patterns, you can actually have other patterns that are formed. They can give you a bit more of an idea of where you're going to go. So if you look very, very carefully at this, that's a shoulder. That's a head. Could you argue this is a shoulder? It depends what time frame you look at it on. This is on the daily. If you do look on the weekly, that could actually be a shoulder. This obviously has not played out, so I can't say if it is or not. I'm not going to sit here and tell you it is or it isn't, because this is not price analysis, this is just chart patterns. But yeah, that is an example of one. So sometimes you can have something like an upside down head and shoulders, which would be an indication that we would go higher. So that would mean that this break would be upwards. This is on the silver chart as well, by the way, if anybody's wondering. This is on silver to USDT. I mean USD. So silver to USD, that one. Right, and then you've got your expanding symmetrical triangle. Right, there's no example for this because I can't find one. But basically, you have something like this, right? You have your triangle as you would normally. You might have some trading that starts off quite narrow, and then we widen up as we go along. There you go. So you have something like that. And that's how your trading would be. And it's the same thing as the other triangle. You come down for your retest, and then you take your measured move, you come down. Or exact same thing, you come upwards and you can have a measured move upwards. So that's the expanding symmetrical triangle. These are quite rare, to be honest, and to be honest, you probably only see this on a higher time frame. You won't really see this on a short time frame. Next, you have a bearish reverse cup and handle. Right. I think the bullish one's on here as well. Yeah, the bullish one's down there, right. So the bearish version of this, let's say you come into a range, you trade up like this. That'd be a cup. So you might have some, I don't know, like some side-to-side trading like this. It's very weird trading. Yeah, some trading like that. And then obviously you'd have your handle over here. Your handle is after USD trade. So you have your trading side here. Right. So you might have, so the idea of this is you have some trading around the cup, and that's how your pattern will be formed. And then also you come down, and then you put a handle in as well. So obviously, like we said before, this could also be a double bottom. So you can have double bottoms and double tops. So for the double top up here, where was it? You can also have double bottoms, obviously, but these are bullish. A double bottom would be something like this. It's the same process, it's the exact same thing, it's just one's bullish and one's bearish. Just think of it as being upside down or reverse. But yeah, so if you have a handle with it as well, and it's a double bottom, these prices will be roughly the same. You put a handle in, and then you take a measure move from here, downwards, and that'd be your bearish reverse cup and handle. Also, on the contrary, you've got the bullish cup and handle too. The bullish cup and handle is something like you might have some trading, you come down, come up. You have your support and resistance over here, and you have some side-to-side trading inside of it. The reason why it's called cup and handle is because it does look like a cup, let's see, and then also a handle. And then you take your measure move again from here and move it upwards. And obviously your entry on these would also be over here. So you wait for it to break out of this, and you wait for a retest, and then you'd go up, and then that's when you can enter. If you want to enter over here, realistically, put your stop loss, I don't know, like inside the cup and handle. These are normally longer term time frames, so you want to be very careful about these. Put your stop loss over there, and maybe put your take profit out. It depends where you want to play it, but normally I'd recommend putting it about 75% of like the measured move. Don't put it under the 100% of it, because sometimes it will not reach that. So you got the bullish cup and handle pattern, and then next we've got the Adam and Eve pattern. Right, Adam and Eve patterns are quite obscure. So your Adam and Eve pattern, you'll have something where you trade downwards, come up. That's a bad pattern. Hold on a minute. Right, so it's the bullish and the bearish one. I'll move this down. So we're gonna do the normal one first. So you got Adam and Eve, and it's something like this. So this is similar to a double bottom, basically. It's called the Adam and Eve double bottom pattern. We have a bottom down here and a bottom down here. These would be roughly at the same prices, and then you take a measure move from here and move your measure move up. And obviously, the same as before, this would be your neckline that you break, and once you break that, you'd come up. That's the Adam and Eve pattern. That's the bullish case. Obviously, the bearish case you can have again, obviously something like this. It is basically just similar to a double top. It's just it's in a different format. This is exactly why I say there's a lot of different forms of stuff you can have, where we basically trade up to a similar price, and then we break downwards, and then you can take a neckline move and take a measure move downwards. The reason why I'm not explaining most of these in full is because the video's already getting quite long. And on top of that, obviously, we have explained how the entries work and how, obviously, where you want to take profits and stop losses. And make sure so you wait for a retest. All patterns normally do retest, so you do need to wait for a retest. Where is the... Right. So down here it was supposed to say there is some writing for a parabolic pattern, but for some reason it doesn't say that, so... This is a parabolic pattern. These are obviously bullish. These are very, very long time frames. This is not short-term trading, this is for long-term trading. This is something like where you put a base in, put another base in, put a third base in, and then obviously you trade back down a little bit, your entry here, and then you put fourth base in, and then we go parabolic, where we trade upwards like this. This is a current Bitcoin chart, so this was a parabolic pattern that we had on the chart. Depends how you like to draw it, but this is a parabolic pattern. So basically, normally what we do is we trade around, come up, and we come up again, and then we come up a bit further. And that's be a base. So it'd be base 1, base 2, base 3, and then what we do is we might have a bit of a move downwards. That really is going to be a good entry for you. And then you have a move upwards. That'd be base 4, and then you have a parabolic move, which is just a ridiculous move up. That's similar to what a parabolic pattern is like. So it's not really one that you can trade to that extent, but realistically you wanna, if you were gonna trade this, you'd enter over here somewhere, like down here. So once you know that obviously 3 bases have been made, then you can enter, and then obviously now you know the base 4 is gonna come, and so on. Obviously, again, you're gonna put stop loss in slightly below. Normally put it in slightly below the wicks. And then, yeah, that's the parabolic pattern. Oh, it's right there. There you go. It wasn't written at the top for some reason. Bullish falling wedge. Right. Very similar pattern to the rising wedge. It's just basically the opposite. So let's say you have your resistance and your support like this. And you trade in between it. You have some trading in between it. And then you break this, same as before. You break this, you come up, retest, and then go higher. And that's exactly the same as most patterns. You retest. This is the bullish version, so the rising wedge is obviously the bearish version. The bullish version is this. Same as before, obviously. This is obviously a reversal pattern. However, if we come up with this, then obviously we're going to go higher. You can measure the flag. So I've got the bullish flag somewhere around here as well. We'll get to that in a second. Right, inverse head and shoulders. So you put shoulder in like this. It's a bad shoulder. You put shoulder in something like that. Have your drawing downwards, and then we trade back up. That's a pretty good head and shoulders. I'm quite proud of myself for that. Right, so you have similar pricing, and then slightly higher pricing in the middle. And then obviously you get the same thing as normal. Put your neckline in. You can take a measured move from about here to about there. Let's say that's your measured move, and then you can move that upwards over here. Let's say that's your measured move upwards, give or take. And then that would be your inverse head and shoulders. This one breaks upwards, and the same as always. retest on the neckline, and then go higher. Flag pattern, right? It's exactly what we drew earlier. So a bullish flag pattern is same as what you would do with a bearish pattern. You can have multiple ones, obviously. You trade downward, you trade upwards, and then let's say, I don't know, we know different types. You can have something like that. You can have some. That's bad. Right, you got something like that. You can have something where we trade side to side, maybe like this, between support and resistance. Something like that. And then you can also have something where, let's say, you have your line. We trade like this, side to side like that. Where we're saying lower lows and lower highs. And that's basically, obviously, our falling wedge as we had them normally. But instead this time we've got a flagpole, so now we can measure the move as well. These are continuation patterns, whereas obviously with the falling wedge, that can most likely be a reversal pattern, where the market's now reversing. So for our falling wedge one, if you come back up to it, let's say we traded upwards into it, that'd be, obviously, continuation pattern. If, let's say, for example, we traded downwards into it, into this range, and then we trade around inside of it, and then we broke out of it, broke upwards, that is a reversal pattern. So the market was going down, and then now it's now reversed to going up. Whereas with the flag patterns, these are continuation patterns. So these, obviously, they indicate the market will continue going higher. Same as before, you put your entries in, as you would normally for most patterns. You wait for a retest and then put the entries in. I think that's all of them. I will throw in an extra one. So you had your double tops, which were something like this. So I'll put this in first. Double bottom. So you had your double tops, which were similar to something like that. Or there's something like this. Now, you can have something different as well. You can have something called a double bottom. Now, your double bottom, on the other hand, would be something like this. You come down, trade up, come down, trade up. And you can have something like this, and you take your measure move from here and move it downwards. So there's all similar kinds of patterns, you just reverse them realistically. They're not too hard to learn. Obviously, don't rely heavily on the patterns. They are good to know, because you can see where the market's going realistically, but they are not 100% accurate, and do not rely on them. Because if you do rely on them, you will get wrecked. Because the patterns don't always play out exactly how you want them to. They can, to some extent, play out how you wish them to, but they won't always do that. Like, for example, say our head and shoulders pattern. These, if they're on higher time frames, they're more likely to play out, to be honest. But on short time frames, they don't always play out. Alright, thank you for watching. Like and subscribe. And I will see you guys in the next video. Bye.